Okay, so the topic of our video today is how much will the Fed's interest rate hikes affect Rockford retirees? Well, the word on the street says that interest rates are slotted to be on the rise in the very near future. So, what does this mean for retirees in the Rockford area? Well, before I answer that question, if you haven't checked out my video on how to avoid one of the biggest retirement mistakes so that you can retire stress free, please check that out now. There should be a link to that somewhere around this video. It's only about 10 minutes long. You'll thank me that I sent you there. So go check that out. Now, back to our question. Let's look at this article right here. How much, this is on Bankrate, this is from bankrate.com. It says, how much will the Fed raise interest rates in 2022? Here's what experts are saying. Now, if we look, it says here, if we scroll down, it says expectations are growing that the U.S. Central Bank will hike interest rates this year by the most since 2005. How much? Well, it depends on who you ask. Goldman Sachs is penciling in 7 interest rate increases, while traders are betting on at least 6, according to CME Group's FedWatch. That's the Chicago Mercantile Exchange Group. So some smart minds are saying, yes, interest rates are very likely to rise over the next year to 2 years. So the question to ask, though, is, what effect is that going to have on retirement investors in the Rockford area and beyond? Well, for a lot of us, it's a big effect because many people have what's called a moderate portfolio, which is about 60% in stocks and about 40% in bonds, right? So bonds have historically helped to mitigate stock market risk over time. So that's why they're in a lot of our portfolios. So they're in there for a good reason. And historically, that has worked. But here we are on the cusp of new times, right? So let's take a look at something I want to share with you. This is just a brief disclaimer here. But let's look at how interest rates work in relationship to bonds. So here's what we need to know. As interest rates go down, bond values always increase. Okay. However, the converse of that is also true. Move this out of the way here. As interest rates go up, which is what we're expecting, right? What's going to happen to bond values? They are going to decrease. We know that. If we're right about interest rates, we know where bonds are headed. Now, if we look at this from a historical view, interest rates have been on the rise, generally speaking, since from 1950 to 1980. And then right around the 1980s, maybe you remember back then when you could get 16% on a CD or more. Since the 1980s through today, interest rates have been on a steady long-term decline. In fact, they hit historical lows. So here we are at this super low environment on interest rates, poised only to go up. And then we have inflation concerns. And of course, the Fed is going to use that tool to try to slow down inflation. And that's going to have what effect? Well, we just talked about it. Bond values are very likely then to decrease. So the next big question should be, well, what do I do to protect myself? If I've got 40% or more of my portfolio sitting in bonds trying to be safe, what do we do? What do we do going forward? Well, we have to look at different things, right? Instead of using bonds to mitigate risk, we need to look at other investments like hedge funds that maybe use options to offset losses, which will give us a little bit of security in our portfolio, because our lows shouldn't be as low if we hedge our investments. That's one way to go. You could also just move heavier into stocks, which is not a bad move, except you're going to then increase your volatility. So you have to be comfortable with that you may be taking on more volatility risk while eliminating interest rate risk. You could look at alternative investments and use things such as structured notes, or even something as safe as an indexed linked annuity where you receive a guarantee of your principal. Whatever you do, There really are many ways that you can adjust your portfolio to reduce interest rate risk and default rate risk of bonds. But you really need to speak with a knowledgeable advisor who looks beyond some of the traditional solutions, because what worked yesterday may not work tomorrow. In the meantime, be sure to check out my short 10-minute video on the big mistake that many retirees are making so that you can retire stress-free. There should be a link nearby. Go check that out now. Thanks again for watching. Take care.